Hello, welcome again. I hope you're having a nice Monday. As I was looking at today's news in the stock market, I bumped into this one. Warren Buffett's Berkshire Hathaway strikes 11.6 billion deal for Insurer company Alleghany Corp. And so when I saw this, I'm like, okay, Warren Buffett actually buys an insurance company. That's interesting. Typically, this can be a little bit of a tough industry to get into, but I wanted to see why Buffett actually purchased the company, purchased stock in the company, in a large stake here, and just analyze the financials of the company. So the next thing that I did after I saw the news here in the tool is fire up the company itself and search for it, and basically take a look at what it's doing financially. And so, as I was going back to the stock analysis tool here, you will see that I have Alleghany Corporation. Now, this is a little bit of a work in progress, so it doesn't have everything that I wanted to have yet. But you will see here that the P ratio of the company is actually sitting at 9. And look at what it used to be some years ago. This is a very handy chart that tells you what the company was doing in the years before. So it looks like it's getting undervalued right now. And the price to free cash flow ratio is again pretty low. We typically want it to be less than 20. And now you're looking at it being at 5.2, which is amazing. It's exactly what I want to see. And the other thing that I like to see with the companies of that sort is outstanding shares getting decreased. And that's exactly what I'm seeing here, from 15.5 million to 13.53, which is the current value. And I have created this tool in a way that shows me what exactly I want to see from a company in a very, very concise manner. And also, I can actually see the charts and the progress through the years. That helps a lot. The 5-year revenue growth, 86.8%, as you can see here, from 6 billion that the company was making back in 2017 to almost 12 right now. So that's a great thing to see as well. The current value is 12 billion over here. And some other things, for instance, the price to sales ratio, again, it's pretty low. I do have some explanations about things here, and you will see that the ratio between 1 and 2 is, generally speaking, good, while anything below 1 is excellent. So this is in the excellent territory here. And the debt to equity ratio is a little bit high, but that is not necessarily a cause of concern. It depends on the industry as well. And some extra information here about the return on equity, for instance, of the company, and a nice price to book ratio, which, although it's 1.02 and it's an X here, the algorithm actually will tell you that everything above 1 is an X. But of course, you have to analyze yourself and think about it a little bit more, because 1.02 is pretty much below 1. It's very, very close to that. So this is still a green for me. And a price to book ratio of that low, with a company that's making great revenue and decreasing shares and a great P ratio, great price to free cash flow ratio, is definitely a company that I'm interested in. But I want to take a little bit of a look at the income statements as well. And from the information that I see here, I see exactly what the company is doing in terms of the actual values. And you will see that the last year was a breakout year for the company, with crazy growth here of 1 billion. And the balance sheet of the company, you will see that the total assets of the company have been increasing as well, very nicely here. And the total equity used to be negative at some point, but now it's pretty much great over here, sitting at 9 billion. So the cash flow is the next thing, and you will see that the free cash flow of the company keeps increasing as well, and reaches $1.2 billion in 2021. So we're looking at a company that's doing fairly well here, and investing also in, as you can see here, in repurchasing common stock. We saw that already, so that's a great thing to see. And also investing activities are also negative here, meaning that the company is paying back for all sorts of things. As you see here, purchases of investments is a pretty big expense, and they have been selling some investments as well. So it's a little bit of selling and purchasing here, where their capital expenditures are also pretty low here, the expenses that they have. So that's a great thing to see, with the operating activities cash flow also increasing throughout the years. But regardless of all these things, I want to use the stock evaluation tool and analyze how much I'm willing to pay for the company. And I'm going to do that by using the revenue growth values that I have examined before. And you will see the averages here. So I'm going to be using something like 15, 17, and 19 here, based on these values. Again, the net income margins are not great, so we're going to go something like 5, 6, and 7. The free cash flow margins, a little bit all over the place. I'm gonna go relatively low, 90, 100, and 110. And annual return of 13% is what I typically like to see from a company, because that's what I want to make. I want to be making at least 10%, because that's what I can make from an S&P 500 ETF. So I'm having more risk here, so I want to be making more. 13% is fair. And look at this. The max price to pay today, even for our lowest estimates here, is sitting at $994, which is way more than the current price. It's like, what, 30 to 40% higher. So that's amazing. I mean, we're looking at a company that I think it's an interesting buy based on the financials and what I'm seeing here. And I wanted to make a video just to show you how Warren Buffett is actually investing in a similar manner to what we're doing here. And that makes a lot of sense to me, because when I'm buying a company that's making these insane amounts of money and it's growing that nicely, and paying this price for a company that's, with my lowest estimates, is going to be worth about $1,000 today, actually, based on these estimates, the lowest ones, then I'm good to buy a company of that sort, because there is a lot of margin of safety. Even if the company doesn't do great, I'm still in a nice spot. And let's just say that the company makes 8, 10, and 12, and we calculate again. And even in this scenario, we are still below, the current price is still below our lowest estimates with an 8% revenue growth. So yeah, this with the very, very conservative assumptions looks like a great company. And this is how Warren Buffett invests, and this is how we should be striving to invest, because we have the potential of making a lot of money throughout the years with much less risk if we invest this way. Now, of course, you may want to analyze the company yourself and see more things about it, but as a quick means of examination and taking a look at the analysis of the tool, we can also take a look at the trends, by the way, see what, actually there's no reported trends for this one yet. I guess it's a very new thing. But using all these metrics here you can see what kind of, financials the company is heading towards. And you can also examine some of the news here and see what is going on with the company, generally speaking. It's pretty much all about Warren Buffett. So this is very, very interesting. I will keep an eye on it through the news module of my tool here. So thank you for watching this one. If you did enjoy it and it helped you a little bit, please leave a like and subscribe if you're not a subscriber. Making tons of content here, and you may enjoy this kind of content, especially if you're a value investor. And in the meantime, take a look at the video that I made earlier, and it discusses Alibaba and what it is doing currently. It's a little bit of a weird time for Alibaba right now, but it looks interesting and a very, very nice value investment for the long run. So thank you for watching, and I'll see you soon, guys. Bye bye.